Hi there, this is Shahroz Sheikh and you are watching Value Investing. Let's discuss the most popular saving scheme of our country, fixed deposit, and compare it with the mutual fund. FD stands for fixed deposit, which is a financial product offered by banks and financial institutions. It is a type of investment where an individual or entity deposits a lump sum amount of money with the bank for a specific period of fixed interest rate. The bank pays interest on the deposited amount, and at the end of the tenure, the original amount along with the interest is returned to the depositor. Advantages of investing in fixed deposits. Safety. FDs are considered low-risk investments since they are typically offered by reputable banks and financial institutions, and the principal amount is secured. Guaranteed returns. The interest rates on FDs are fixed at the time of investment, providing predictable returns. This can be beneficial for risk-averse investors who prefer stability. Liquidity options. While FDs are for a fixed tenure, many banks offer premature withdrawal options with some penalty. This allows investors to access their funds in case of emergencies, though it might reduce the overall returns. Regular income. FDs can provide a steady source of income, especially if you opt for a periodic interest payouts, which can be useful for retirees or individuals looking for fixed income. No market risk. Unlike investments in the stock market or mutual funds, FDs are not affected by the market fluctuations, making them less susceptible to economic volatility. Now let's see the disadvantages of investing in FDs. Lower returns. FDs generally offer lower returns compared to other investment options like equities or mutual funds, which have the potential for higher growth but come with higher risk. Inflation risk. Since the interest rate on FDs is fixed, there is a risk that the returns may not keep up with inflation, resulting in a decrease in the purchasing power of the money over time. Opportunity cost. By investing in FDs, you may miss out on potential higher returns that could be achieved by investing in other avenues with more significant growth potential. Taxation. The interest earned on FDs is subject to taxation, and depending on your income tax slab, it can significantly impact your overall returns. Lock-in period. Once you invest in an FD, you commit to a specific tenure, and withdrawing the money before maturity might result in a reduced interest rate or penalty charges. Overall, FDs can be a suitable investment choice for conservative investors who prioritize safety and stability over higher returns. However, for investors seeking higher growth and willing to take on more risk, exploring other investment options may be more suitable. It's always best to consider your financial goals, risk tolerance, and time horizon before making any investment decisions. Let's see the advantages and disadvantages of investing in this instrument. The choice between fixed deposits and mutual funds for the long run depends on the financial goals, risk tolerance, and investment preferences. Each option has its advantages and disadvantages. Let's start talking about returns. Mutual funds. Mutual funds have the potential to provide higher returns over the long run compared to FDs. They invest in a diversified portfolio of assets like stocks, bonds, and other securities, which allows them to participate in the market's growth. FDs offer fixed and relatively lower returns, which may not keep pace with inflation. The interest rate is fixed at the time of investment, so you know what to expect, but it might not be as lucrative as potential market gains. Risk. Mutual funds. Mutual funds are subject to market fluctuations and carry higher risk compared to FDs. Depending on the type of mutual fund, equity, debt, balance, etc., the risk level varies. While equity funds can offer high returns, they also come with higher volatility. FDs. FDs are considered low-risk investments. The principal amount is secure and you are guaranteed to get the initial investment back along with the fixed interest at maturity. Liquidity. Mutual funds. Mutual funds offer better liquidity compared to FDs. You can redeem your mutual fund units at any time, and the money is usually credited to your account within a few business days. FDs. FDs typically have a fixed tenure, and while some banks offer premature withdrawals option, there might be penalties or reduced interest rates for early withdrawals. Taxation. Mutual funds. The taxation of mutual funds varies based on the type of fund and holding period. Equity mutual funds held for more than 1 year enjoy long-term capital gains tax benefit, whereas debt funds are subject to indexation or flat tax rate based on holding period. FDs. The interest earned on FDs is fully taxable as per your income tax slab, which can significantly impact your overall returns, especially for individuals in higher tax brackets. Diversification. Mutual funds. Mutual funds provide diversification as they invest in wide range of assets. Diversification helps spread risk and can potentially lead to more stable returns. FDs. FDs do not offer diversification since you are putting your money into a single fixed deposit account. By investing in these assets, we realized in the long run, mutual funds have the potential to outperform FDs due to the power of compounding and exposure to various asset classes. However, with the potential for higher returns comes higher risk. If you have a long-term investment horizon, are willing to take on some risk and seek the potential for better returns, mutual funds might be a more suitable option. On the other hand, if you prefer low-risk fixed returns and want to protect your principal amount, FDs could be the better choice. But here inflation plays an important role and eats the return you get on your FDs. So you must consider over this aspect as well. It is essential to consult with a financial advisor to align your investment with your financial goals and risk tolerance. Diversification, which includes a mix of different asset classes, is often considered a prudent approach to long-term investing. If you find this video useful for you, do like and also subscribe to this channel. Click on the notification bell so that the upcoming videos will pop up quickly on your screen once it is posted. Bye for now.